There's a metal box, fireproof, waterproof, bolted to concrete in someone's basement. Inside, it sits $30,000 in cash. The owner sleeps better at night knowing it's there, safe, protected, untouchable by banks, hackers, or market crashes. 5 years later, they open that box. Every bill is still there. Not a single dollar missing. But they've lost $7,000 anyway. This is the paradox of safety. The thing you did to protect your wealth is the exact thing that destroyed it. And it's not just happening in basements with cash. It's happening right now in savings accounts, in treasury bonds, in strategies that financial advisors tell millions of people are conservative and smart. The defense is killing the patient. And almost nobody talks about it. Let's start with what seems obvious. You have money. You want to keep it safe. So you put it somewhere that feels secure. A savings account, a certificate of deposit, maybe government bonds if you're being sophisticated about it. These aren't risky bets. They're not speculation. They're the financial equivalent of locking your door at night. Except your door has a slow leak. And the leak is invisible. Here's the mechanism most people miss. When you put money into a safe place, you're accepting a deal. The deal is simple. In exchange for safety, you get a return. That return is called interest. Right now, in early 2025, a high-yield savings account might give you around 4% annually. A 10-year treasury bond might give you 4.5%. 4% sounds fine. Better than nothing. Better than losing it in a bad investment. But there's another number that exists, whether you think about it or not. Inflation. The rate at which the cost of everything rises. And right now, depending on how you measure it, inflation in the United States is running somewhere between 3 and 3.5% per year. So let's do the math that most people never do. You put $10,000 into a high-yield savings account earning 4%. After 1 year, you have $10,400. Your money grew. You protected it and it grew. That feels like winning. But inflation ran at 3.2% that year, which means the same basket of goods that cost $10,000 last year now costs $10,320. Your real gain isn't $400. It's $80. You made $80 for an entire year of locking up $10,000. That's a real return of 0.8%. Less than 1%. You worked, you saved, you protected, and your purchasing power barely moved. And that's in a good year. Now, let's talk about a bad year. Let's say inflation spikes to 5%. That same savings account still pays you 4% because interest rates on savings accounts don't move as fast as inflation does. Banks are slow. They're businesses, they don't rush to give you more. So now you're earning 4%, while prices rise 5%, you've gone backward. Your $10,000 becomes $10,400 in the account. But the purchasing power of that money is now worth less than the $10,000 you started with. You did everything right. You avoided risk. You didn't gamble in stocks. You didn't buy cryptocurrency or gold or real estate at the peak. You were responsible, and you lost money anyway. This is called negative real return. And it's not theoretical. It's not rare. It happened consistently throughout the 2010s when inflation was low but savings rates were even lower. It happened aggressively in 2021 and 2022, when inflation surged past 7% while savings accounts paid barely 1%. Millions of people, trying to protect their money, watched it quietly evaporate. The cruel irony is that the safer you tried to be, the more you lost. Because the safest places, the places marketed as zero risk, are also the places with the lowest returns. And low returns in an inflationary environment don't mean slow growth. They mean slow destruction. Let's zoom out. Imagine someone in the year 2000. They have $50,000. They're conservative. They don't trust the stock market after the dot-com crash. So they put that money into a savings account, earning 2% per year. They feel smart. They avoided the crash. They kept their money safe. 25 years later, in 2025, they still have that money. It's grown with compound interest to about $82,000. They more than doubled their money without taking any risk. Except inflation, over that same period, averaged around 2.5% per year. Which means the $50,000 in purchasing power from 2000 would need to be about $92,000 today just to buy the same amount of goods and services. Their $82,000 is worth less than the $50,000 they started with. They spent a quarter century protecting their wealth, and they lost 15% of it. This gets worse when you factor in taxes. Because the government doesn't tax you on real returns, they tax you on nominal returns. Meaning they tax the number that shows up in your account, not the number adjusted for inflation. So you earn $400 in interest on that $10,000. The IRS sees $400 of income. If you're in the 22% tax bracket, you pay $88 in taxes. Now your $400 gain is $312. And remember, inflation already ate $320 of your purchasing power. You're underwater. You paid tax on money you didn't actually make. This is the hidden violence of low returns. You're not just losing to inflation, you're paying for the privilege of losing to inflation. So why do people do this? Why do millions of intelligent people keep their money in places that are mathematically guaranteed to erode its value? Because loss hurts more than gain feels good. This is one of the most well-documented findings in behavioral economics. Losing $1,000 causes more psychological pain than gaining $1,000 causes pleasure. It's not rational, but it's deeply human. So when someone has money, the idea of protecting it from loss becomes more important than the idea of growing it. The fear of losing 20% in a stock market crash outweighs the certainty of losing 2% per year to inflation. Because the crash is dramatic. It's visible. It's an event, but inflation is slow. It's silent. It's not a loss, it's just things costing more. Your brain doesn't panic about things costing more. It panics about numbers going down. There's also a trust problem. The stock market feels like gambling to people who don't understand it. Real estate feels expensive and complicated. Bonds sound boring and technical. But a savings account is simple. You put money in, the number goes up. You can see it. You can access it. It's backed by the government up to $250,000 through FDIC insurance. That insurance is real. If your bank collapses, you get your money back. But the insurance doesn't cover inflation. It doesn't protect you from the thing that's actually eroding your wealth every single day. You're insured against the earthquake, but not against the termites. Now let's talk about bonds. Because bonds are where this gets even stranger. Bonds are supposed to be the smart version of cash. You lend money to the government or a corporation, they pay you interest. And you get your principal back at the end. Safe, predictable, boring, in a good way. But bonds have a weird feature that most people don't understand. When interest rates go up, the value of existing bonds goes down. Because why would anyone buy your bond paying 3% when new bonds are paying 5%? They wouldn't. So if you need to sell your bond before it matures, you have to sell it at a discount. This is what happened in 2022 and 2023. The Federal Reserve raised interest rates aggressively to fight inflation. Suddenly bonds that people bought in 2020 and 2021, thinking they were safe, lost 10, 15, even 20% of their value. People who thought they were being conservative watched their bond funds crater. They didn't lose money because they took risks. They lost money because they avoided risks in the wrong way at the wrong time. Here's where it gets philosophical. What does it even mean to protect money? If protection means keeping the nominal number the same, then yes, a savings account protects your money. The number doesn't go down. But if protection means preserving what that money can do, what it can buy, the life it can provide, then a savings account might be one of the least protective places you can put it. Money isn't paper. It isn't numbers on a screen. It's a claim on resources, on goods and services and time and labor. And if your claim shrinks every year, you're not protecting anything. You're just losing slowly enough that it doesn't feel like losing. This is why wealth inequality keeps growing even when people are trying to be responsible. People with money in assets, stocks, real estate, businesses, see their wealth grow faster than inflation. People with money in cash and savings accounts see their wealth grow slower than inflation. Over decades, that gap becomes a chasm. The rich get richer not because they're taking huge risks. Often they're not. They're just taking slightly more risk than the people trying to stay completely safe. And in an inflationary system, slightly more risk is actually the safer long-term choice. Let's come back to that person with $30,000 in the fireproof box. 5 years later, they open it. The cash is there, but coffee costs more. Rent costs more. Gas costs more. A car costs more. A vacation costs more. Everything costs more. That $30,000 now has the purchasing power of maybe $23,000. They didn't spend it. Nobody stole it. It just became smaller. And here's the worst part. They can't see it. The number 30,000 is still 30,000. The loss is invisible. The tendency to think of money in nominal terms rather than real terms. So what's the alternative? Because saying don't keep your money in savings accounts sounds reckless. It sounds like telling someone to go gamble in the stock market or buy speculative assets. And that's not the point. There's only choosing which risk you're willing to take. Holding cash has risk. The risk of inflation. Holding stocks has risk. The risk of volatility. Holding real estate has risk. The risk of market timing and maintenance and liquidity. Holding bonds has risk. The risk of interest rate changes and opportunity cost. Every choice is a trade-off. And the people who pretend otherwise are either lying or don't understand how money works. The mistake isn't choosing safety. The mistake is thinking safety and inaction are the same thing. There's a deeper problem here too. The system is designed this way. Inflation benefits borrowers and punishes savers. Governments are the biggest borrowers in the world. They have every incentive to allow moderate inflation because it slowly erodes the real value of their debt. Your loss is their gain. And when interest rates on safe assets are kept artificially low, either by central bank policy or by market conditions, it forces people into riskier investments if they want to preserve wealth. It's a nudge, a quiet push away from safety and toward risk. Not because risk is good, but because safety has been made expensive. It happened in the United States after World War II to help pay down war debt. It's happening again now. Person B has about $418,000. Yes, they endured volatility. Yes, there were years where the number went down. But over 15 years, the difference is staggering. Person A protected their money, and it barely grew. Person B took measured risk and multiplied their wealth by more than 4 times. Now adjust both for inflation. Person A's $125,000 has the purchasing power of about $104,000 in 2010 dollars. They made $4,000 in real terms over 15 years, less than $300 per year. Person B's $418,000 has the purchasing power of about $348,000 in 2010 dollars. They made $248,000 in real terms. Person A protected their money. Person B protected their future. None of this is an argument for recklessness. It's not a pitch to go all in on stocks or crypto or whatever the hot asset is today. It's an argument for honesty, for looking at the math, for understanding that the thing that feels safest might be the thing that's quietly destroying you. Because here's the uncomfortable truth. In an inflationary system, doing nothing is not neutral. It's a choice to let your wealth erode. The defense became the threat. The safe harbor had a leak, and the leak was always there. You just couldn't see it because it was happening too slowly to notice. So what now? What do you do with this information? Because it depends on your timeline, your goals, your risk tolerance, your need for liquidity, your tax situation, your age, your income, your everything. You can't pretend that a savings account is protecting you when the math says otherwise. Maybe you decide the psychological benefit of having cash available is worth the inflation cost. That's valid. Maybe you decide to split the difference, keeping some in cash for emergencies, and putting the rest in assets that have a chance of outpacing inflation. That's valid too. But make the choice with your eyes open. Understand the trade-off. Understand what you're giving up. Because the most expensive financial mistake isn't taking the wrong risk. It's taking a risk without knowing you're taking it. It's losing money while thinking you're keeping it safe. The box is still locked. The money is still there. But every year, it buys a little less. Every year, the protection costs a little more. And nobody's coming to warn you. Nobody's sending a letter that says your wealth is eroding. The number just sits there, the same as it always was, while the world gets more expensive around it. That's the secret. Protection isn't free. Sometimes, it's the most expensive choice you can make.